Good evening, guys. How are we? This live, I want to cover some of the rumors, some of the things that are being muted that will come out in the autumn statement, the budget, in about 11 days' time. And so I'm going to run through some examples. But before we actually get started, um, if you've not subscribed to the channel already, please consider subscribing. And if you do find value in these kind of videos as well, be sure to smash the like button. It would just mean that other people get to see this video as well, get to actually benefit from some of the stuff that we're going to be talking about. I appreciate it's a Sunday evening, so I'm just going to jump straight into it. So, the budget is supposed to be on November 17th. It was pushed back from October 31st. And as you know, the government is trying to plug quite a large fiscal hole, so a deficit in our finances as a country. I did a video on Tuesday talking specifically about the fiscal hole, so maybe go watch that video if you've not seen it. But the rumored amount that they're looking to fill is around about 62 billion pounds. It's a lot of money. So we've been made aware, or at least they've signposted, that one of the things that they're going to be doing is looking at increasing taxes in some way, shape, or form, alongside spending cuts. I'm going to be talking about some of the stuff that is being muted that they're talking about on the tax side, first and foremost. And the first place that we're going to go for this is going to be capital gains. So, capital gains tax is essentially, let me just share this with you. Capital gains tax, there is an allowance for capital gains tax, which is £12,300. Okay. So, if you own an investment property, or if you've been investing in stocks, shares, crypto, the gain that you can make before you start to pay tax is £12,300. Now, the government in 2020, 2021, that tax year, made about £14.3 billion from capital gains. So it is a big income stream for the government. And they're looking at essentially tightening capital gains to increase the tax take and potentially close that gap that we have in our national finances. So the allowance at the moment is £12,300. Now, how the capital gains allowance essentially works is if you've got a buy to let property, for example, right, you will pay a certain percentage of capital gains tax over and above the £12,300 allowance if you're a basic rate taxpayer and if you're a higher rate taxpayer. Now, basic rate taxpayer means that you're earning between 12,571 and £50,000. Most people fall within this bracket. To be a high rate taxpayer or additional rate, high rate taxpayer, sorry, you need to be earning between 50,000 and £150,000. So there's a big gap there. I'll show you the tax brackets in a moment. But if you're a basic rate taxpayer, essentially capital gains on property is 18%. And if you're a high rate taxpayer, it's 28%. If you've been invested in stocks, crypto, that kind of stuff that we talk about here on the channel, then if you're a basic rate taxpayer, you're going to be paying 10%. Oh, undo that 1 second. You'll be paying 10%. And if you're a high rate taxpayer, you'll be paying 20% essentially. Okay. Now, I've got a couple of examples here. So if you had a buy to let property, for example, right, which you sold for £200,000, but your purchase value for this was £150 when you actually £150,000 when you bought it. Well, that means that you've got a gain here of £50,000, which means that by the time you take off your allowance of 12,300, your taxable gain is going to be £37,700. Now, if you are a basic rate taxpayer, and there's a little bit more of a nuance to this right here, which I'll come to in a moment, you'll be paying 18%. So on a gain of £37,700 on a property sale, your tax bill is going to be in the region of £6,796. If you're a higher rate taxpayer, then it'd be 28% at £10,556 pounds that you'll basically pay. If you're in stocks, it's slightly different. So if you invested 150, you sold your stocks or your crypto at 200,000, then the same equation applies, but the level of tax that you're paying in this bracket is different, which means that you're paying 10% on 37,700 to give you a tax bill of 3,770, and at 20% is double that, 7,570 essentially that you'll be paying. Those are some brief examples, okay, of how capital gains will essentially work. Now, What they're planning to do, essentially, what the rumor is that they will either reduce the exemption quite a bit, so that £12,300 pound exemption that we currently have will be reduced. We don't know by how much yet. It might go down to £10,000. It might go down to £9,000. We don't know. Or they're actually looking at bringing up the rates that you pay more in line with income tax numbers. So if you think about it, as a basic rate taxpayer, you're paying 20%. So you could see that your capital gains tax as a basic rate taxpayer goes up to 20%, up 18 on property, up to 10 on stocks, crypto, shares, those kind of things. And indeed, if you're a higher rate taxpayer, potentially up to 40%. Those are the two ways in which they can actually target capital gains specifically, which is being muted right now. There is another contentious part as well. So currently, if you live in your house, so this is my house, right? Residential. You're living in your house, it's your residence, it's your primary home. If you sold your house tomorrow and you made a gain of 100 grand, you wouldn't have any capital gains to pay on that at all. Now, it is being muted that essentially they are thinking about basically making sure that everybody pays capital gains on the proceeds of residential sales. That will potentially raise 30 billion a year. Now, that's a pretty unpopular policy, I would think. And I think if he does that, I'm not sure that a lot of people will take that very, very lightly, particularly with property prices increasing. And typically, when people sell houses, the money that they have in terms of equity that they realize typically goes to a bigger deposit for another house to pay tax, capital gains tax on the proceeds of your residential property. I don't think will go down too well at all. So whether he'll do that, I don't know, but he might introduce a small something. He might have to offset it with a reduction in stamp duty just to offset it. But essentially, this is what they're talking about. This is what is being muted, apparently. The other thing that is being muted, apparently, is dividend tax reductions. So currently, if you receive any dividends via stocks or you're working for your own, you're self-employed, you're director of your own company, you're taking dividends, the dividend allowance at the moment is £2,000. It used to be £5,000 back in 2017. They are muting, or is being rumored that they're going to reduce that down to £1,000, which basically means that it will become less attractive if you're a business owner, you're self-employed, to take dividends because, well, essentially you're going to be paying more tax on that side, although it will still be better because ultimately you're going to be paying less tax than if you took it as income potentially. So there's always that conundrum to have a look at, but there is potentially a reduction going to be happening. Now, I have actually got a couple of things here on the board just to show you guys. These are the current dividend allowance rates, okay? So as a basic rate taxpayer, the dividend rate right now is 8.75. That's just been increased, by the way. As a higher rate taxpayer, it's 33.75%. And as an additional rate taxpayer, so if you're earning over £150,000, it's 39.35%. So the allowance potentially is going to be reduced from 2,000 down to 1,000. The other way they could do it, which I'm not sure they're speaking about, but it has definitely been maybe suggested, is they increase these rates right here. But they have just been increased anyway because that one was 7.3% or 7.5% prior. So we've already seen an increase there. So they might just reduce the dividend tax allowance down, or the dividend allowance, I should say, down from £2,000 to £1,000. It's looking as though it's a little bit of a stealth thing, and this brings me on to the next thing, which actually under the radar doesn't feel as though it's going to make that much of a difference, but potentially will, and that is freezing the tax brackets. Now, if you didn't know, these are your tax brackets currently, okay? So you have a personal allowance of £12,570. You're a basic rate taxpayer at 20% if you're earning between £12,570 and £50,270. Then you break into the higher rate at 40% once you earn over £50,271, all the way up to £150,000, so 400, 190, £149,000 99 pence, right? Then anything over 150 is at 45% additional rate. Now, what they are thinking of doing is basically freezing these thresholds right here. Now, that might seem like it's not going to be a big deal, but as we just explained, if, for example, you are already earning in this bracket right here, and let's just say you've invested in some stocks, you've invested in some crypto, right? And you've had a gain of 20 grand, right? Now, obviously, the allowance, assuming it stays the same, will be £12,300. So the uh, you're going to pay capital gains on the amount minus your 20,000 minus your 12,300. Now, if you're already within this tax bracket, your gain is going to be added to your level of income here. So potentially, you could be in an environment where you're supposed to be paying 18%. Oh, sorry. Potentially 10% tax, or you thought you might be paying a 10% capital gains tax bill, but because there's a freeze on the income brackets for tax purposes, it could push you into a higher rate, potentially where you're going to be paying 20%, potentially. That's something. It's very, very stealth in that way. That is rumored to essentially be worth maybe about 6 billion quid a year to the government. So there are a lot of changes coming potentially down the pipeline when it comes to taxes and stuff. There isn't anything that I know of at the moment around the reduction in your ISA allowance at the moment. Your ISA allowance, would it be an immediate tax take? I'm not too sure, actually. I'm trying to work that in my head if it will be an immediate tax take, because your money sat inside your ISA is money sat inside your ISA. They're looking at the most effective ways to be able to get a tax take over the next few tax years to balance the book. So I've not heard anything about ISAs. I'm not even too sure whether ISAs would be something that they would actually target, because how would that relate to an immediate tax take? Not too sure just yet. But look, for sure, there are some changes coming when it comes to taxes, for sure. And that was just a little rundown of what I found out over the last couple of days, just to keep you guys informed. Hopefully, you find it useful and stuff. But yeah, just be prepared, I suppose, for it, because it is coming down the track, and there is no denying that at all. I'm just going to go through the comments really quickly. Yes, Aiden's just asking here, with an ISA, you don't pay tax. Will that change? I don't think it will, personally. I don't think it will. There isn't anything to say that, or there isn't anything indicated at the moment to say that they're looking at it. But Jeremy Hunt did say that everything is on the table, so we could be wrong. On November 17th, it might just so happen that they've got something around ISAs in there as well. Justice is saying, gosh, there would have to be caps or exemptions if they remove the principal residence rule. People use the gains to move up the ladder, which is exactly what I just said there. Yeah, I mean, there would have to be some way of appeasing people if they did do that. Hopefully they don't do that, because, yeah, I mean, for a lot of people, that will be a real kicker, a real kicker. Zero, what's Zero saying? Maybe they could say if you buy another UK property within 6 months, you won't pay capital gains tax for your residence. Well, that's true, but what happens if you can't secure a place in 6 months? You know, some of the lead times to actually complete on a property is very, very long sometimes, depending if you're in a chain. So how do they actually administer that? I don't know, but really good suggestion though. And compounders are saying we're overdue a rise in the dividend tax-free allowance. It used to raise with inflation. It has been stuck at 20,000 for several years. Do you mean ISA allowance there, or because the dividend allowance specifically it's £2,000 now. It was £5,000 in 2017. So the ISA allowance has kind of remained the same for a good number of tax years right now. So maybe that's what you meant there. But I think, look, everything is on the table at the moment. They're not rolling anything out really, so who knows what's going to happen? But all eyes on the 17th. Again, as we round this off, if you've not already done so, there's 51 of you at the moment. please smash that like button. Let's get that up to 40. That would be amazing. It would just mean that other people who might find this useful and may benefit from this will also get to see the video as well, because YouTube essentially will push it out a little bit more. They'll think, oh, people actually interacted and found that useful. So it's a really good metric for the YouTube algorithm. Appreciate you. Look, I'll continue to do these things as and when we find out more. But there is a lot in the works at the moment. It is what it is, right? Scary times. Actually, I ran a poll earlier today, yesterday, I should say, asking people how they're feeling about the increase in the cost of things around them. And, 74% of people at the moment on the community tab are saying they're actually really, really worried. So, let's just say proactive, vigilant, and do all the things that we need to do. Anyway, guys, have a good evening. I will speak to you